of the surrounding, and apologies for the pension board.
Thank you. We've got 5 board members present today. We've also got a new chairman of the pension board, being David Stainthorpe, taking over from David McKee. And we have 2 pension board members here who are here for their first meeting, being Colin Graham and from Unite, and Jan Andrews from Unison, who's taking over from Sheila Smith.
Welcome, I'm sure you're delighted to be here. Okay, item number 3, any declarations of interest from members of the pension subcommittee? And item number 4, any declarations of interest from the pensions board? Okay, we'll move on to item number 5, which is a report by the external audit on the financial year 17-18. Anything you want to add to the report?
Nothing to add at this stage, thanks Chair, but if I could I pass on to Joanne and Angela, who are here from Grant Thornton, our external auditors, to introduce the report, please.
Thank you. If I just give a brief introduction and pick up our key messages, this is our final report which concludes our audit on the pension fund. Just to clarify, we're independent of the pension fund, and the good news is we're proposing an unqualified opinion, which after this meeting we'll sign in these sets of accounts. Just like to say thank you very much to the council officers and Andy in particular around the pensions and the quality of the working papers, and for all their support and help.
Thanks, Joanne. Yeah, I'll just pick up and echo that point. I feel that overall the audit went very well. We built on our existing relationships with the officers, which resulted in a more efficient and high quality audit. So there were no issues noted in the testing we conducted over our significant risk areas, which we're quite happy to report to committee. Equally, there were no adjustments required to the accounts. And just to again echo the point made by Joanne, that the audit opinion is that of an unqualified opinion. There were no actions raised or recommendations made in the current year. However, we did follow up on prior year actions. There were 2, and both of which are now closed. So all in all, a very positive report. Happy to take any questions on that.
Thanks very much. Any questions? Stephen?
Thanks, Chair. Yeah, it was just on page 13. It shows, it's just in terms of the net assets statement. And it shows you there just in terms of like benchmarking, etc. And it does allude to the fact that Dumfries and Galloway was under the average in the current year, but it was just actually the wee bit where it's under the bar, as it were. There's a sort of orange block there for 2015-16, and it was really just to get a wee bit better understanding as to what that represented, if that's possible.
Trying to think back, I think in the 2015-16 accounts, the actual market value of the fund fell slightly. It was just the fact, it was the way that the fund was set up at the time, and there was a couple of, I think it was property investments.
I think one of the questions that used to always feature at the pension subcommittee was about the RREEF, and I'm sure it was just to see if that coincided with the time of the SHCEME at the BlackRock thing, because I think there was one component of that had still been outstanding, or had still some time left to run, and it was kind of an albatross on the fund, effectively.
We still have a small element with that, but it was about that time that it was taken over by Bailey. I think it was 2015-16. Yeah.
Any other questions? So we'll move to the recommendations. Members asked to 2.1 receive the external auditor's report on the 17-18 audit as detailed in Appendix 1. 2.2 note that no issues have been identified in the course of the audit which have impacted on the fairness of the financial statements submitted for audit as detailed at paragraph 3.1. Happy to note. 2.3 approve the letter of representation to be certified by the Head of Finance and Procurement and appended to the audit report as detailed in Appendix 2. 2.4 approve the audited accounts which will be certified by the Head of Finance, Procurement and Grant Thornton after this meeting as detailed in Appendix 3. And 2.5 note that the certified accounts were made available to all members before the 31st of October this year, when they will be available on the Council's website. Thank you very much. We move to item 6, which is the Investment Strategy Review report by Head of Finance and Procurement. Anything you want to add to the report?
Thanks, Chair. Yeah, this is a follow-up report to the Investment Strategy Review report that members received at the May meeting of this committee. At that initial meeting, members agreed that the high-level changes to the investment strategy and asked us to go away in conjunction with Hymans to have a look at asset allocations in a bit more detail. Hymans have come back with a detailed report on the various options for taking forward that high-level strategy. Paul's going to introduce that report, and that's been brought forward in terms of recommendations in the report for members today. But maybe ask Paul to introduce the detailed analysis initially, please.
Okay, thank you. Yes. If I could take you through to what's page really, I'll go through to page 38, which is the start of the main body of the report. Please, as we go through the various elements of this, do chip in and interrupt if there's things that you want to discuss rather than leave it all to the end. But if I'll skip the executive summary and try and bring out the main points of the report as we go through. Really on page 38, it's just a reminder, as Paul said, that there's been very much two stages to this process. We used a lot of modelling to think about the high-level strategy, and then in this report we very much drilled down into very specific allocations and very specific decisions on managers. Just a quick reminder of the modelling on pages 39 and 40. We were forecasting forwards over a 20-year period and seeing how the fund might evolve under different contribution assumptions and investment strategy assumptions. And we were looking at the chances of being fully funded in the future, and also looking at a measure of downside risk in the event that we got some bad investment outcomes. And the conclusions are shown there on page 40. The committee wanted to retain an ability to reduce contributions in future potentially, and on that basis we weren't advising any switching into low-risk bonds for the moment. But we did think that modest switches from equity investments into other return-seeking assets would improve the overall risk-return profile of the fund. And in addition, those investments that should deliver a kind of reliable income flow in the future and a more stable pattern of returns would be helpful given the sort of gradual deterioration in the cash flow position. We also noted that if there was a significant improvement in the funding level, that might allow a modest increase to low-risk bonds. Our belief at the moment, or our estimate at the moment, is the funding level is probably only 2 or 3% higher than when we last met in May. So that requirement, which might have triggered more de-risking, hasn't been met in the interim period. We modelled a strategy at the time that we labelled lower risk 1 diversifying, and that had certain characteristics in terms of its allocations to equities and income assets and low risk assets. And the recommendations that we put in the paper have very similar characteristics to that portfolio. They're not identical to the asset allocation, but they have the same sort of broad risk return characteristics, and they're consistent with the modelling that we did then. So if I can look at each of the components of the fund in turn, just moving on to page 41, the table at the top shows the target allocations to equities across the three types of mandate: the passive UK equities with Legal & General, passive global equities with Legal & General, and the actively managed mandate with Templeton. The first point we've made there on page 41 is this issue of the split between UK equities and overseas equities. About 18 months ago, we proposed a change for the fund to go from having a kind of bias to the UK to a bias to overseas equities. And that has been a long-term trend really for pension funds in the UK. And the reason for that is that the UK stock market is very concentrated in quite a small number of stocks. So particularly when you hold those assets on a passive index tracking basis, you end up with some very big individual holdings relative to the global equities that you have. So again, to improve the kind of the balance of the equity portfolio that the fund has, we're proposing that we take this opportunity to kind of move that balance further and reduce the allocation to UK equities relative to overseas equities, because I think that gives you a better balanced equity portfolio overall. The second issue then is the kind of active-passive discussion that we've had in the past. We have the actively managed mandate with Templeton, and the return chart is shown there at the top of page 42. The performance of the manager since inception has been quite poor, but the nature of that performance is it's tended to come in waves. There have been quite long periods of the manager underperforming and then periods of the manager outperforming very strongly. I think we've discussed before, the manager has a very distinctive investment style where they're doing what's called value investing, looking for undervalued companies. So in the table in the middle there, we've shown the performance of the Templeton Fund against its benchmark, the MSCI, and the middle row there, you can see the relative performance numbers do make pretty grim reading. Lead across to the right, since inception, 1.3% per annum behind over what's been a 10-year period. We've also looked at the performance relative to an index called the MSCI Value Index, and that's kind of carving out the stocks within the world index that would qualify as value stocks. And all we're saying there is, given that the manager is going to invest in that part of the global index, how have they performed relative to that value index? And you can see that, you know, they've been more successful at matching that. In fact, over the long term, you know, marginally ahead, although in line since inception. So that's kind of consistent with the pattern we'd expect to see. It's been a period when value investment has really struggled, and you can see that on the next page, at the top of page 43, where we've shown the long-term performance of this value index against the MSCI global stock markets in general. And it's been quite a prolonged period that this style of value investing has underperformed. So the manager's faced quite a long headwind, but we can't get away from the fact that, you know, the fund has lost a lot of value through that mandate. Just in terms of characteristics, I mean, these value characteristics that some companies have can be seen as one of the factors driving performance over the long term. And there's been a lot of work done on the different factors that do drive stock performance over time. A lot of work has been done in the last few years, and a lot of alternative indices have been developed that try and sort of capitalize on these factors. And 5 of the main ones are quoted in the middle paragraph there. 5 of the most common factors that have been identified in terms of producing long-term performance have been these. We've listed value, quality companies, size in terms of small companies, low volatility in terms of the characteristic of the price, and a factor that's called momentum. I won't go into the details there, but this work has led to a lot of different indices being developed which try and give you a different type of equity portfolio than the traditional market cap indices that we invest in. The reason I mention that is that I think where we are at the moment is we give Templeton some credit for sticking to their investment process and their philosophy. We'd be wary of terminating Templeton at the moment and just putting the assets into a straightforward passive mandate, because I think if that recovery in value stocks comes, then we completely miss out on that. If we were to fire Templeton and look for another active manager, the risk is that we would be appointing someone where, you know, their style had been in favour and had been performing well. And then, you know, you then run the risk that you're going to someone who's been doing badly in the past. So, sorry, do you want to come in there? Yeah.
It's at what point do we make that decision then? Because we seem to be giving Templeton this run of time. Whereabouts would that break point actually be? Because although you're saying the preference is to retain Templeton, you believe that there is this passive investment opportunity. But what is the breaking point? I think that's where I'm coming to, the breaking point.
Yeah, and I think the recommendation here is that we could use some of these passive, low-cost index approaches in a way to ensure that we don't miss out on any recovery in these value stocks. So one of the options we have, and that we'll want to look at in a bit more detail, is can we terminate the Templeton mandate, and rather than put those into the kind of the passive assets that we have at the moment, can we put those into a mandate that would actually capture some of that recovery in value if it came? It would be a mandate with very low fees. It would effectively be an index tracking mandate. And we can think about the different factors that index might include, but one of the ones that might be quite prominent would be this value factor. And I think that gives us a bit of protection against coming out of Templeton at the wrong time. We can effectively reduce the fees and say, but if we get this value bounce, we will have moved them into a mandate where we get some benefit of that. This whole area of factor-based investing is not something we've discussed here before, and the recommendation is that we do specifically look at that as an alternative to the Templeton mandate when we've had a bit more time to understand how those approaches work. But if we have a follow-up session on that, the aim would be to come to a decision pretty quickly then on which way we're going to go. So we're not making that decision today, but we're saying that there is an alternative here, lower fees, which avoids this risk of missing out on a rally, and we think that's quite attractive. But because it's relatively new, we don't want to suddenly put that on the table for a decision today. But I think that we would want to reach a decision reasonably quickly once we've looked at that.
Same point, Chair, but obviously if we're looking at a passive option, one of the things that strikes me as part of the argument from moving in terms of the equities is the fact that in the UK equity scenario, your main players, your sort of blunt instrument trackers, are going to follow the very small number of stocks that make up most of the market. So even though we might be reducing or proposing the reduction of that percentage, what remains will still be following those very small number of determining sort of stocks that shape the market. So are the options that we might be looking at other passive indexes that actually don't follow those at all, but they look at the likes of, you're saying, the value ones, so there's actually specific products that would follow specific aspects of those five indices that you're talking about?
Yes, there are indices that are put together in a different way, so they're not as concentrated in individual stocks. Now, I guess when we look at the Templeton mandate, though, we're looking at a global mandate, so we might put that into a global index constructed in this other way. They do exist in the UK, but they're not so widely used in terms of funds, because funds have a lower allocation to the UK. But we could look at that as part of the round, yes, because while we keep the UK equities passive, we will still have that concentration, albeit on less of the fund. So that's essentially our recommendations on 43 and 44. If I can take you on to page 45, we've got here the other growth assets, and in that category we've put the Baillie Gifford Diversified Growth Fund. If you remember, this has a long-term target of producing a return 3.5% per annum over cash. It invests in a kind of basket of different growth assets. It has a pretty low allocation to equities. It tends to run at about 20% in equities, and the rest of the fund is in types of credit, in commodities, in insurance bonds, infrastructure, according to where Baillie Gifford think they can pick up long-term returns. When stock markets are doing really well, the returns from this fund will look pretty pedestrian, churning out 3, 4, 5% per annum. But having said that, if you get a market correction, it'll offer you a very high level of protection against that. If we get a 20% fall in stock markets, we'd expect this fund to hold up very well. So it should give us a more stable pattern of returns. Our proposal, jumping ahead, is to look to increase allocations to income assets, but what the Baillie Gifford Diversified Growth Fund does allow us to do potentially is to reduce our exposure to equities relatively quickly, given that it might take a period of time to build up some of the investments, some of the other investments that we're going to talk about. So, we like that fund. It gives you protection against equity volatility. We'd rather ultimately have the assets elsewhere, but we are recommending a kind of temporary switch into the Diversified Growth Fund while we fund some of the investments that we're proposing.
Thanks, Chair. Again, it's maybe a timescale thing, but temporary in this respect, I mean, how long is that?
I mean, that could be 12 to 18 months. I mean, we'll come on to some of these income asset classes, but the way some of them work is that, we have to go through the process of choosing a manager or a fund, and then we would generally commit an amount of capital to this fund, but then only as the manager finds investments will they draw the capital from us. So it can be quite a prolonged period before all that gets invested. Now, we could just wait and pull that out of equities, but the risk then is in the next 6 or 12 months, we get a correction in equities, and actually we've managed to move only a very small amount of money. So this kind of lets you take equity risk off the table now, and then in that 12 to 18 month period, slowly fund the other investments.
Just want to confirm, Paul, there's 2 areas of training where we're recommending for members today. I think that the multi-factor passive investment training, that could be done fairly quickly, and we could probably cover that at the next meeting, whereas, as you say, the alternative income asset classes training, there's a bit more to that, and there'll be some selection process beyond that as well, so that'll maybe take a greater period, but the initial look at multi-factor passive investment we can actually address very quickly.
Oh, straight, yes, absolutely, yes.
Yeah.
If I can take you on to page 47, then this is moving on to the income assets, and the only current allocation that we've categorised as income assets is your investment in property, where we've got 3 balanced commercial property funds. We think in principle property is a really attractive asset class. It gives you some diversification from equities. There's a really strong income return. There's some kind of long-term inflation protection inherent in the asset class as well. So this is an asset class where we'd be comfortable seeing a higher allocation. I have flagged at the bottom of the page there, it's fundamentally quite an expensive asset class to get money in and out of. The bid-offer spreads, if you like, the cost of purchasing property can be quite high. So to the extent that we can pick up any units from a seller in these funds means that we get in at a much better price. And so we'll have to kind of monitor the market in conjunction with the officers to see where there's opportunities to do that. But we'd like to aim to get the overall allocation to property sort of modestly higher. So we're recommending that we look to move that up to 12% rather than 10% in UK commercial property. And there's a comment at the bottom there saying there are some specialist types of property as well, which we've kind of touched on in the past here, whether it be sort of residential property or social housing, and anything like that would come along as a kind of one-off ad hoc investment opportunity to be thought about. What we're talking about here is sort of an exposure to UK commercial property along the lines of what we have already. So you shouldn't expect to see anything esoteric appearing as part of the extra 2%. On page 48, we start talking about the new income assets. We've recommended, obviously, that we look to increase the allocation to assets that are largely driven by an income return. And we've briefly mentioned 3 new asset classes. On page 48 and 49, we've mentioned infrastructure, we've mentioned private debt and long lease property. Again, these are new asset classes to the committee, so we'd want to spend a bit of time being comfortable with exactly what these are and what they aren't. I've tried to summarise briefly on the front what infrastructure is. The attractions for pension schemes are that the returns are very much dominated by income. They often have some kind of inflation linkage, although not always. And a lot of those assets there are not influenced by the normal business cycle that, for example, your equities are. Now, some of them will be. I mean, in the middle there, airports. The fortunes of an airport arguably does tend to rather ebb and flow with the business world. But most of the others, your risks are political risks or regulator risks and things like that. They're not going to follow the normal economic cycle that's driving your property and your equities. All of these three asset classes have one characteristic, and that is that you are tying your capital up for a period of time. You can't just go out tomorrow and invest £50 million straight into infrastructure. The way these funds work is that you make a commitment to a manager that you'll invest. As that manager finds opportunities and assets to buy, they will keep drawing cash off you. So the commitment you've made stays invested in your current assets, in this case, the diversified growth fund we suggested. And then as the manager comes along and says, can we have 5 million for this? Or can we have 10 million for that? You just pass that money over in bits over a period of time. Your money is tied up for a period of years, but local authority pension funds are in a position to be able to do that, unlike most private sector pension schemes. And there's evidence that you do earn an extra reward for taking that illiquidity risk, for tying your capital up. And that's something that you can afford to earn given the type of fund that you are. Private debt is the second one I've mentioned at the top of page 49. There's been a lot of funds launched where managers are making direct loans to businesses rather than the banks. This is reasonably sort of high quality lending, and the fund will have a kind of portfolio of business loans which are made by the managers. So pension funds, to an extent, are kind of replacing the banks in some types of business financing. The returns on those types of funds probably in the region of 5% per annum, and given that our long-term forecast for equities are only 6% per annum, we think that's pretty attractive, and then the return largely comes back to you in a form of income flow. And the third one at the bottom, long lease property. It's a particular subsector of the property market where you have very high quality tenants, very long leases, and it's the characteristics of that really almost sit somewhere between a bond and a normal commercial property. It's the very lowest risk property that you can access. So just moving to the top of page 50, we're aware that there are 3 brand new asset classes that are just on the table today, and we all want to spend a bit more time sort of looking at those in more detail. And in terms of accessing those, we could either aim to make a specific allocation to each of those 3, for example, and then go out and find a manager and a fund to invest in and effectively have 3 separate allocations. Or it is possible to invest through what's essentially a kind of diversified income fund. So in the same way that Baillie Gifford run a diversified growth fund for us, there are funds available that will say, we will invest in types of private debt, types of infrastructure, these kind of illiquid assets, and actually we will wrap that into one pooled vehicle. That has the advantage of not having to start a selection exercise for lots of different managers, and also having to handle all the cash flows coming in and out for all those different individual funds. So one option for implementing something that might look a bit complicated is through one of these diversified income funds. And we've just given an example in the report of one that happens to be run by BlackRock that delivers that kind of product for clients. Finally, just going through to page 52, on bonds, we have a small allocation to emerging market bonds. Now, I've flagged at the outset, we don't put those in the low risk category. Emerging market debt is a bit higher risk than normal bonds, and as has been evidenced in the last 3 to 6 months, where sentiment has turned quite negative on emerging markets, but the yield on these bonds over time tends to be pretty high. So we tend to regard this as a source of return rather than a low risk asset. We'd thought at the outset that we might move this into a kind of multi-asset credit mandate, look at other types of high yielding bonds, but actually the way markets are at the moment, a lot of those other types of bond, the yields have been pushed down really, really low, and it just feels like a bad time to be doing that move at the moment. So what we've said on this page is, let's leave that allocation for the moment. We think emerging market debt is cheap at this level. If in the future we want to roll that out to other types of high yielding bonds because conditions are more favourable, then we'll come back with a specific recommendation. Then finally, the low risk bonds at the bottom. These are just there really to manage the overall risk of the portfolio. They're high quality bonds. They're there to stabilise the returns, help stabilise the funding position. We've had a split between gilts, index-linked gilts and corporate bonds. We have made a recommendation on page 53 saying that although we do see some merit in holding index-linked bonds, it gives you a bit of protection against kind of spikes in inflation in the short to medium term. But on the fixed interest side, we'd have a preference to have a bias towards corporate bonds there. They're still high quality bonds, investment grade, but they're giving you a bit more return than the government bond equivalents. So on the basis of that, we'd rather split that 15% with kind of 10% in fixed interest corporate bonds and the 5% in index-linked gilts. So we're recommending that the fixed interest gilts just get switched into corporate bonds just to tweak an extra bit of return from that.
Quick question. It was just actually to go back to the private debt aspect, and in terms of like grouping how we are able to look at this, it strikes me that the private debt is just a sort of higher risk corporate bond, effectively, where you're maybe being a bit more selective about who you're lending directly to, and then that return where you get the return of income over the years, and then a sort of final capital payment or whatever. But I mean, is there, beyond the risk level, is there much of a material difference?
The main difference is a corporate bond is something you can just go and buy in the market, whereas the loans within a private debt fund are specifically negotiated between the manager and the business. So the business doing the borrowing is too small to issue a corporate bond. It has to come to a deal effectively with banks or pension funds. One of the main differences is that the companies you're lending to in the private debt funds will probably be sub-investment grade, so they'll be a bit lower quality than investment grade corporate bonds. And those businesses will be paying a higher premium effectively because they're having to negotiate a deal rather than issue a bond in the market, and because their debt is sub-investment grade. So part of that pickup reflects the fact that the debt is a bit lower quality, and part of it reflects the fact that you're having to tie your capital up for a period of years rather than having a corporate bond, which arguably you could just go and sell again tomorrow.
Okay, that helps. Thank you.
In terms of bringing those together, we've included a table on page 54, which just again pulls out the difference between the kind of the short-term actions and the longer-term targets. The proposed short-term target reflects the reduction in UK equities, with that being taken up by an investment in the Diversified Growth Fund and a small increase in the allocation to property. But the ultimate target is for that Diversified Growth Fund investment to go back to where it is today, which is kind of in the region of 10%, and that for that 8, to have made its way into these investments in the middle. Now, if we make individual allocations, I'm not saying that 4 and 4 are necessarily, need to be the final answer. We may make individual allocations between those three, or we may look to use a diversified income fund where that 8% is allocated across those asset classes, maybe dependent on where the manager sees the opportunity. So that pulls out kind of the short-term recommendation, but the ultimate target is where we're suggesting the fund tries to get to.
Any questions? Graham?
Thank you, Chair. I noticed in that particular block, you haven't put anything against long lease property. Are you worried about that? Or?
It's not so much worried as being it's a smaller asset class, and it can be quite hard to get money in. So if there was a fund available where we thought we could get a reasonable amount of money in, then we might want to make an allocation of a couple of % or so. But if I could get money in anywhere, I'd have a preference for infrastructure and private debt. And if we can make a modest allocation to long lease property, then that would be good as well. But I'd probably have less in there than the other two.
My next question is probably a daft laddie question, but I'm used to them. How do we pay these investment companies that you put the money through, Bailey Gifford and whoever else? And is there any chance we could put them onto a performance-related pay scale?
Some of these new investments will be performance-related. The Diversified Growth Fund, the problem is with that is because they're targeting an absolute return of 3 or 4%. If markets are really strong, if all their bond markets are really strong and their equity markets are really strong, they could easily post 10%, and actually you'd half expect them to. And then when markets are really quiet or going down, they might post 0. So with that type of mandate, the performance fees are a bit, you could get stung for performance even though the manager hasn't done well. But the new investments, a performance-related element tends to be built in to those types of vehicles. So there will be some in there, almost whether we like it or not, because that's how the funds tend to be structured. I don't know what the position is with Templeton, whether they've performance-rated fee. No, sadly not. Probably.
Templeton are just, it's a fixed fee, but we get a rebate on the fee.
I don't suppose we ever get to a position where they pay us back, do we?
A rebate's nearly there to a payback, is it? Jim?
Thanks, Chair. Paul, I'm just slightly surprised by the confidence you're showing in the UK property market, because at this time we hear politicians coming away with lurid claims of a 1/3 drop in the value of certain properties. We have businessmen trying to renegotiate long-term leases for retail properties.
Yeah, I mean, there is a big split in the property market at the moment. If you're on the high street, it's grim and miserable, and rents are falling and prices are falling, and it's pretty horrible. And if you've got a big warehouse out by the motorway or on the ring road or the bypass, then the prices have been going through the roof. So you do need to be pretty careful. And I can see the point about property is it is an exposure to the domestic economy, and we don't want to get dragged into a kind of Brexit discussion. But I suppose there is a short-term risk that there could be some markdowns in prices. But when that happened before, in big parts of the market, buyers came in again to buy those properties. But I think you're relying on the manager as far as possible to position the portfolio in the best places. Having said that, it's hard for them to move the assets around. And the overall asset class, the returns have been, as we'll see later, the returns have been pretty good. And there's a bit of a short-term risk there, as there are in different parts of the fund.
David?
Thanks. Every time you change something, there's fees involved and costs and charges involved in that. And I just wondered,
if there was any sort of information on the amount of time it would take to recoup by the investments, the costs of the change.
Yeah, it's a tricky one because we're coming out of equities into something that's lower risk. So, in a way, you don't expect higher returns from the fund we're moving into. So there will be a cost of coming out of equities into the Diversified Growth Fund, for example. I mean, that might cost, let's say it costs up to 0.5% of the assets that we transfer, just taking everything out there. You know, we're not expecting the performance in the Diversified Growth Fund to do better than equities. So in that sense, we don't expect to recoup the performance. We're making that change because we're deliberately taking some investment risk off the table. If we were going from one manager to the other, we'd expect to recoup the switching costs. But in a way here, we're not. Where I think there will be a cost of going into the new assets, but I think there we will get a better return. So I think we will recoup that. But coming out of equities, arguably we're not doing it because we think we're going to higher return. But we need to be conscious at each stage of what the costs are.
Henry?
Yeah, thanks, Chair. Paul, just on the same theme as costs, are we at the position where we're at the optimum fee for all our accounts and the charges that are being imposed on us?
Given the size of assets we have, in a way, the optimum, the lowest fee comes from having the largest assets in one place. So, we would reduce fees by consolidating all the assets and putting them in one place. But in terms of the fees on the passive assets have been reduced significantly in the last year or so. The passive managers will come along and shave those down to a fraction of what they used to be. So on the passive assets, the costs are very keen now. We are going to revisit the cost of active management and the cost of passive management and decide whether we want to pay the active fees against the passive fees. And that's that's an important decision when we look at factor-based investment. In terms of the new investments, you're a sizable fund making a meaningful allocation, so we can use as much muscle as we can to get decent fees, but in some of these areas money is flowing in and therefore the managers become less flexible on fees, unfortunately. So I don't want to. I think what we have now has been pushed down as far as we can go, and the passive has been a big benefit.
Coming back on that, can we quantify then if the passive investments, the fees have been reduced as much as we're saying? Can we quantify what that means in pounds, shillings and pence?
I could pull together something showing the reduction in the passive fees over the last couple of years to show what we would have paid and what we actually have paid with the reduction. And it's mainly through the legal and general pool vehicles. I could do some of that and circulate amongst members.
Any other questions? Yeah.
Paul, it's just really for reassurance. The interim approach almost doubles the fund's allocation in Baillie Gifford's Diversified Growth Fund, and that's a fund that's generally performed very well for this committee. But the last quarter was a very difficult one for that fund. Just for reassurance, is there anything that members need to be aware of or concerned about in relation to that?
I mean, it was a bad quarter. They were down 1 or 2% or so. They tend to have quite a big exposure to emerging markets in different ways, and what they had in the quarter was emerging market bonds. And the sentiment against emerging markets has been really poor, not only because of the trade war twittering that's been going on this year, which is really bad for emerging markets, but the strong dollar as well. So that's hit them quite hard, and they messed up on a position in terms of the Argentine currency as well, where they were long. So occasionally they will get hit, but it's still the same team with the same collection of assets. That the long-term performance has been good. There's been the occasional wobble, but it's really when something's come along that's hit a chunk of the portfolio. So, we will occasionally see a bad quarter, and they've occasionally had them in the past, but the product continues to be run by the same people in the same way, and so we're confident it'll keep delivering this kind of steady, maybe 4 or 5% return.
David?
Thanks. Just in terms of the infrastructure potential assets there, you've mentioned on page 48 the Scottish Futures Trust. It's one of the few direct things that you've mentioned. So I just wondered if you could give us a bit more information on that.
Yeah, sorry, I meant to pull that out. I mean, there is an initiative within Scotland to encourage Scottish pension funds to look at infrastructure or development or property opportunities within Scotland. And a manager has now been appointed to think about how it might structure vehicles to do that. And our research people had a couple of meetings, and I know they've been around seeing all the officers as well, just to see what appetite there might be. So what we're saying here is that we're aware of that. We know what they're trying to do. We've seen different iterations of what that might look like. And that is something that's on our radar and, could be of interest. We're not saying that the whole infrastructure allocation of the fund needs necessarily to be in Scotland. We tend to say to clients, actually, the opportunities in infrastructure are all over the world, and some are more attractive than others. So ideally, you have a manager who can get the best returns from wherever they are. But that doesn't preclude us from looking at a specific vehicle, that's being developed in Scotland. So it's on our radar. We're kept in touch with what's happening, as are the officers here. And some kind of proposition will come along, and I imagine it's something that'll, be in front of the committee for consideration at some point. And maybe you're closer, Andrew, than me.
No, I just, as Paul says, we attend an officer investment group every quarter, and I think it was at the end of last year that Scottish Futures Trust came along to a meeting and put forward a couple of proposals. Obviously, the size of our fund and our ability to invest in infrastructure, it was something I said we may be interested in, but I would have to go through Paul to get some kind of reassurance that what they were proposing was suitable for us. I think we're still in fairly early stages. I mean, as Paul says, there has been a manager appointed to sort of look at producing a vehicle which is available. But I would assume that before we make any commitment to anything like this, we would require a level of training from Hymans to show what the pros and cons of the vehicle are, the risks, etc., and the suitability to the fund.
Henry?
Just on the same point, Chair, at those meetings, Andy, is when there's opportunities such as the Scottish Futures Trust and all the Scottish pension funds being represented there, are there opportunities for pooling at this type of investment? We are pooling all the funds together to invest in something like the Scottish Futures Trust.
My understanding of what the Scottish Futures Trust were proposing would be some kind of pool. They would create a vehicle looking at investing in infrastructure, etc., and the various funds could put or commit to that pool, and the funds would be drawn down as and when required. So it wouldn't be us or the Dumfries and Galloway pension fund making a commitment to specific projects. We would make a commitment to the Scottish Futures Trust, who would then be looking at several projects along with the funds from other pension funds.
Any further questions? No, I'll move to the recommendations then. 2.1, are we happy to note the contents of the presentation and review of investment strategy August 2018 by Hymans Robertson? Yep. 2.2, agree to revise the investment strategy from the current allocations as follows. And save me all reading them out. It's in 4.13. Is everyone okay with that? Yep. 2.3, agree that the increase in allocation to diversified growth funds should be viewed as a temporary measure while investment in alternative income classes is reviewed, as in detailed in 4.6 below. 2.4, agree to receive training on both multi-factor passive investment in 4.5 below and alternative income asset classes in 4.8 to 4.10 below to allow these options to be considered as part of the investment strategy. Stephen?
Yeah, and just if we're recording the action to circulate the difference in costs for the passive pooled vehicles, I think we're asking for.
Yep.
Thank you.
Move on to item number 7, which is the Local Government Pension Scheme Administration Update. Is there anything else you want to add to your report?
Chair, happy with the report and happy to take any questions.
Any questions? No. Getting off scot-free. If everyone's happy, we'll move to the recommendations. 2.1, note the updated position regarding data quality for pension administration records held by Dumfries and Galloway Council Pension Fund. Noted. And 2.2, the positive review of data carried out on common and conditional data types, exceeding the national average, and the positive work to address data errors through the implementation of Data Improvement Plan at Appendix 1. Stephen?
Thanks, Chair. And just maybe to, I remember enjoying reading this report the last time it came here, but just to commend the work to be in a position where we're exceeding the national average and setting a high standard. And that should be passed on to the staff, I think, as well. Thank you.
Yeah, I think we can all agree with that. That staff are commended and be grateful if you could pass that on. Thank you very much. Move on to item number 8, which is a consultation and a review of the structure of the local government pension scheme in Scotland. Want to add something to the report?
I don't really have anything to add to the report, but I'm happy to answer any questions that members may have.
I think some of us attended a really interesting meeting about this in Edinburgh a couple of months ago, didn't we? And listened to a speech by a Cabinet Secretary that didn't mention pensions very often. But does anyone have any questions or comments on the report? Stephen?
Thanks, Chair. Yeah, it did seem to be encouraging us towards option 3, I think it was, in terms of the sort of pros and cons type thing, but that's not explicit in the recommendation, so I take it that's just really for information just now, and then we'll sort of get more information in terms of the circulated draft response. Is that kind of how it would go?
I think certainly my understanding is that this is very much at consultation stage. The Scottish Government don't seem to have a preference as to what we do, but really just a general review. Do you want to add something to that?
No, just as the member said, the intention is to draft a response on behalf of the fund and we'll circulate it to members for comment, etc. Just going through, as you correctly say, there's this concentration on the 4 aspects of the cost, the governance, risk, infrastructure, and then how that relates to the 4 options. So we'll go through that. We'll draft something up, circulate it, and ask for comments before we agree a response on behalf of the fund. Just as an aside, at the board meeting earlier on, it was mentioned that it may be a case that the board make a separate response. The consultation is open to anybody, so if any individual, we can go down to an individual level, if anybody has an individual view on this, then they're quite entitled to make a response themselves. The intention is to make a response on behalf of the Dumfries and Galloway Pension Fund as a whole, but to say it's open to either sections of the board or individuals to do so if they so wish.
Any further questions?
Not so much a question, more of a comment. I mean, clearly there may well be some changes to the way investments happen, and the subcommittee is very focused on the investment side of things. But there's the administration side of the pension fund as well, and we would certainly be hoping that whatever changes there are, the administration side has a local element to it, and maintains that local position.
I think certainly that's a view that's shared by everyone, particularly in a time we have higher ERVS applications and subsequently payments to be made. Do you want to add anything more to that?
Just, I think to can add to that the local expertise that's across the 11 funds in terms of the administration side, and certainly with the meetings that I've attended on the administration side, there's a real sense of that local expertise, and obviously it's open for views, but it's just to put that message across as well.
John?
Yeah, thank you, Chair. It's just for clarification what you said about the Cabinet Secretary not mentioning it. I'm clearly reading the Secretary's forward here, and it's everything about the LGPS, but you're saying that he never even spoke about pensions.
It was at the event that we were at. He was talking a lot about the economy. It was the day after he had been given a new brief, and I think he mentioned pensions twice or something like that, didn't he, in a 20-minute speech. Just a side remark.
Yeah, but I mean, we're looking at the papers in front of us. This is what we're talking about at the Pension Committee, not what you were referenced to.
Okay, I was just giving the subcommittee and the pension board an update that there has been meetings that I as chair of the committee have attended, and to give some feedback on that. Any further questions? No. Move to the recommendations. To note 2.1, the contents of the report on consultation on the review of the structure of the Scottish Local Government Pension Fund, carried out by the Pensions Institute on behalf of the Scottish Local Government Pension Scheme Advisory Board as detailed in the appendix. And 2.2, the intention to circulate a draft response for consideration and comments prior to a response on behalf of the Dumfries and Galloway Pension Fund being put forward for approval at the November 2018 meeting of the subcommittee. Noted. Thank you. We'll move on to item 9, which is the annual training plan. Anything to add to the report?
Just a couple of items to highlight rather than add. One is obviously there's still 1 or 2 members who have yet to complete the pensions regulator toolkit. At the last meeting, which is mentioned here, the IGG meeting in the beginning of September, there was a speaker there from the pensions regulator, and it was emphasised there that one of the things they are looking at is a relevant level of training for members of both Pensions Committee and Pensions Board. So I encourage everybody to, if they can take the time to complete that training toolkit. Most people have done it. There are 1 or 2 still to complete. If you have done it and haven't let us know, again, could you please let us know? And just as a quick mention, I circulated details of the LGC investment seminar, which has been held on 23rd and 24th of October. The intention is to let them know, well, the intention was to let them know by the end of the week of the uptake from the Dumfries and Galloway Fund. I've had several responses, both positive and negative. If you're not intending going, could you please let me know so that I know that you're aware of it? And the ones who are going, we'll send out more details. I got an update on what's going on at the seminar, and there are going to be a couple of issues. I'll circulate this to members when I get back on the agenda, looking at longer term, the pooling arrangement, possible pooling arrangements, etc., etc. So I think there are 1 or 2 items on the agenda there which are relative to what we're looking at just present. I say I'll circulate this when I get back to the office this afternoon. If anybody else is intending going, if you can let me know as soon as possible so I can advise the organisers accordingly.
Any questions? Yep, Stephen.
Just whoever on page 90, I think it is, it gives you the record of training, but whoever vacancy is, they've got the best record of all, so just
Something for us all to aspire to. Any comments or questions? No, we'll head to the recommendations. To note the additions to the Training Plan 2018-19 in Appendix 1 following the previous meeting of the subcommittee. To note the progress to date in the record of training in Appendix 2 and the process for updating the record of training. And note 2.3, the online pension regulator public service toolkit training available, and the background information about what is responsible investment is also available and is now overdue for completion. Happy to note.
could we, given that it's overdue for completion, can we maybe, I suppose, those who are overdue will be encouraged to complete that as soon as possible?
No, absolutely. It's one of those I can promise I have started, but I'm sure we can get a timely reminder sent out to relevant members.
If I could maybe just put, if any member is wanting some kind of assistance, if there's 2 or 3, we could maybe arrange a session where we sit down with you, we can set up a couple of laptops, etc., and assist both members of the committee and the board in going through the training sessions if people would find that helpful.
Sounds like a useful self-help group, I've got to say. Item 10, I've got no other business deemed urgent. Item 11 is the Local Government Scotland Act. Are we happy to consider adopting the resolution to exclude the public from this meeting in terms of section 50A(4) and paragraph 9 of part 1 of Schedule A of 7A of the Local Government Scotland Act 1973? Agreed. And then we'll move on to item 12. Anything you want to add?